A colossal miscalculation totaling billions of dollars has occurred. For the past 48 hours, the titans of Wall Street have been embroiled in an urgent endeavor. Their objective was straightforward: to obliterate the price of silver. Their aim was to depress it significantly before the year concluded. They intended to trigger stop-loss orders and shatter the optimism of bullish investors. For a brief period, it appeared their plan had worked. The price plummeted to $70.50. It resembled a collapse, marking what seemed to be the end of the recent surge. However, an unforeseen event, absent from their strategic blueprint, transpired. The selling pressure abated, the price rebounded, and as we now approach the final hours of the year 2025, silver has recovered to $71.83. The daily chart displays a doji candlestick indicative of market indecision and signaling the exhaustion of selling momentum. The major financial institutions unleashed their full force upon this market only for it to absorb the onslaught. Rather than extinguishing the rally, their aggressive price manipulation inadvertently created an exceptional acquisition opportunity for their rivals. They effectively reduced the price for entities such as China and Samsung, precisely those who are actively depleting physical silver reserves. This in-depth market analysis will expose the bank's trap and elucidate why the drop to $70 was a regulatory maneuver driven by year-end accounting necessities rather than genuine market fundamentals. We will examine the Shanghai Premium, which continues to trade significantly higher than the US price, underscoring the immense demand for physical silver. Furthermore, we will dissect the market setup for the 2nd of January. While the banks attempted to clear their positions, they inadvertently left the gateway wide open for substantial capital to enter. Their price suppression strategy has failed, and the foundation for a significant price increase has been established. This is the narrative of a misstep that could prove exceedingly costly for these institutions. To comprehend the magnitude of this error, one must consider the pivotal level of $70. This was the resistance barrier that had contained prices for months and the breakout point from several weeks prior. During yesterday's sharp decline, the price directly encountered this level before hitting an immovable wall. It did not falter further to $68 or $65, it halted abruptly. This indicates the presence of a strategic buy order situated at $70. Industrial consumers and sovereign entities have pre-programmed orders to acquire any available supply at this price point. The bank sought to drive the price lower to incite panic among investors. Instead of fear, they encountered readily available liquidity. They divested their silver holdings at reduced prices to strong, committed buyers, transferring ownership from speculative paper traders to discerning physical asset accumulators who prioritize intrinsic value. This represents a critical flaw in the strategy of a short seller. The objective is to cover short positions by purchasing from less committed investors, not to offload them to those with a long-term perspective, as these strong hands typically remove the metal from circulation. By driving the price to $70, the banks accelerated the depletion of physical inventory, making it more affordable for global buyers to acquire the metal. Now let us analyze the trading volume during the price recovery. Currently trading at $71.83, we have seen a recovery of nearly $1.50 from the lowest point. The chart clearly depicts a long lower wick, a technical indicator signifying rejection. The market descended, assessed the lower price, and rejected it, deeming it excessively cheap. This rejection is occurring on the final trading day of the year, a critical detail. It implies that despite immense pressure, including tax loss selling and liquidity adjustments, the market intends to conclude the year on a strong note, ideally above $70. Maintaining a price above $70 preserves the bullish trend observed on both monthly and yearly charts. As long as this level holds, the damage to the chart is superficial, a mere flesh wound, leaving the fundamental structure of the bull market intact. We must address the G-SIB surcharge, a bureaucratic element that served as the underlying catalyst for this price fluctuation. G-SIB stands for Global Systemically Important Banks. Under the Basel III regulations, the world's largest banks are assessed based on their systemic risk at year-end. This assessment relies on a snapshot of their balance sheets taken on December 31st. If their calculated systemic risk score exceeds a certain threshold, they are subjected to billions in additional capital requirements for the subsequent year. Consequently, every year in late December, these banks engage in a form of fire sale, liquidating assets, closing derivative positions, and reducing their overall exposure. Their selling of silver is not predicated on a belief in its price decline. Rather, it is a necessity to become more cash-rich and asset-light. This is a regulatory contrivance, an attempt to appear less significant to supervisory bodies. However, the crucial factor is that on January 2nd, this regulatory snapshot period concludes. The capital requirements ease and banks can resume their normal operations, which include trading, hedging, and acquiring assets. Therefore, the selling pressure observed yesterday and today is artificial, possessing an expiration date coinciding with the end of the current day. Once the new year commences, the G-SIB pressure dissipates, and the natural dynamics of supply and demand reassert themselves. This is why the decline to $70 constituted a bear trap, luring retail investors into selling at the market's nadir. The perceived selling by banks was, in fact, a window dressing exercise, a temporary repositioning. Anyone who sold yesterday due to this regulatory push has been outmaneuvered by the accounting departments of financial institutions. Now let us examine the Shanghai data you have provided. This serves as definitive evidence. While New York witnessed a sharp decline to $70, what was happening in Shanghai? Shanghai did experience a price drop, falling from $82 to $75.58. This was a substantial decrease. However, carefully observe the spread. New York is currently at $71.83, while Shanghai is at $75.58. The disparity is approximately $3.75. Even after the market crash, silver remains nearly $4 more expensive in China than in the United States. The arbitrage gap has not closed. It has narrowed, but it remains sufficiently wide to indicate ongoing demand. This implies that the strong demand persists, with metal continuing to flow from west to east. The banks may have manipulated the paper price, but they cannot alter the physical reality of China's demand for silver. As long as this premium persists, the floor beneath the US price remains solid. A collapse to $60 is improbable when China is willing to pay $75. Arbitrage mechanisms will prevent such a scenario. Let us discuss gold as a stabilizing factor. Gold is currently trading at $4,346, showing a slight decline. However, in contrast to the volatility experienced by silver, gold is demonstrating remarkable stability. It is resisting a significant downturn, indicating that its role as a monetary asset remains robust. The global concern regarding debt and currency debasement persists, and investors are not divesting their protective assets. They are merely adjusting their hedging strategies. Silver, as a higher beta asset, has experienced pronounced fluctuations, dropping 10% while gold declined by only 1%, a typical behavior. However, gold's resilience provides a safety net for silver. Silver cannot experience a severe collapse while gold is trading at historical highs. The prevailing ratio prevents this. Should silver become excessively cheap, algorithmic trading systems would likely sell gold to purchase silver. Thus, gold is acting as a protective elder sibling, shielding silver from aggressive downward pressure. Now let us consider the trading volume. The volume during the price decline was substantial, reflecting liquidation. However, the volume accompanying today's rebound is constructive and steady, indicating accumulation. We are not witnessing panic buying, rather it is value-driven purchasing. Sophisticated investors are entering the market and acquiring contracts at $71, building positions for the new year. This quiet accumulation often signals a more robust, bullish trend than a sudden surge in volume, suggesting that less committed investors have exited and inventory is transferring to those with a long-term commitment who are unlikely to sell for short-term gains. We must also briefly reconsider the tax loss selling aspect. Today represents the absolute final opportunity to realize a capital loss for tax purposes in the current year. Investors who purchase silver miners at their peak or silver itself at $83 may be selling today solely to benefit from tax deductions. This generates non-economic selling, driven by tax code incentives rather than investment conviction. Tomorrow, this incentive vanishes. In fact, the incentive reverses in January. Investors will have new tax allowances, enabling them to purchase assets without immediate tax implications for the next 12 months. Consequently, the tax headwind transforms into a tax tailwind by Friday morning. So, what is our current position? We are somewhat battered, and the chart appears somewhat disarranged. However, the underlying investment thesis remains intact. The banks made a strategic error by pushing the price this low. They presumed they could break the market. Instead, they have merely cleared out leverage positions, reset the relative strength index, cooled market sentiment, and invigorated the bull market. At $83, the market was becoming overheated. Now at $71, it is oversold. From a technical standpoint, this presents a far more favorable environment from which to initiate a rally. The fuel tank has been replenished. In the subsequent analysis, we will delve into the January effect, explaining why G-SIB selling concludes tonight and institutional pension fund buying commences on Friday. We will identify specific price targets for the anticipated recovery and examine the disconnect between the physical and paper markets, questioning why dealers are still imposing substantial premiums despite the decline in spot prices. The error has been made, the trap has been sprung, and now the market is poised to exact a price for this manipulation, a price that will be higher. We must now turn our attention to the initial 48 hours of the year 2026. While the banks are recovering from the G-SIB squeeze, a new significant force is emerging: pension funds. We have previously discussed the January effect, and the current circumstances have solidified this prospect. The year is officially closed, and the data is finalized. Silver emerged as the top-performing asset class of 2025, outperforming the S&P 500 bonds and real estate. This performance creates a mandate for institutional investors. Pension funds and endowments operate under stringent guidelines, actively seeking superior returns. Upon their return to the office on Friday, January 2nd, they will have fresh capital allocations to deploy. Reviewing the performance leaderboard for 2025, they will observe silver's leading position and question their existing exposure. The probable answer will be insufficient. Consequently, a significant reallocation process will begin. Trillions of dollars in passive capital will shift. A portion of overvalued technology stocks will be sold, along with some underperforming bonds, to acquire the outperforming asset, silver. This investment activity differs fundamentally from the buying observed from the banks today. The banks were motivated by the need to cover short positions, effectively neutralizing an existing trade. Pension funds, conversely, are establishing long-term positions, engaging in accumulation, and removing supply from the market for extended holding periods. The combination of bank short covering and institutional long-term accumulation creates a powerful 1-2 punch that can propel prices vertically. We have effectively purged the market of sellers, just as buyers are poised to enter. The path of least resistance is now clearly established. Let us examine the yearly candlestick. Technical analysis is applied across various time frames, including daily, weekly, and monthly charts. However, the yearly chart often provides the most compelling signals. We have just witnessed the formation of a substantial green candlestick. Depending on the data source, it is likely a Marubozu, opening near its low and closing near its high, signifying complete market control. The bulls have dominated the year. For trend-following algorithms, particularly those managed by sovereign wealth funds, this represents a buy signal of the highest order, indicating a shift from a bearish to a bullish long-term trend. While these algorithms operate with a degree of inertia, their impact can be profound. They will likely implement purchase programs throughout the entirety of 2026 based on this single yearly candle, signaling a secular shift in capital flows that could persist for years. Returning to the dealer market, despite the paper price rally of $4 today, has the physical market become more accessible? No. Our checks with major dealers indicate that premiums have not diminished, nor has inventory significantly increased. Typically, during price surges, individuals sell their older coins back to dealers. However, today, dealers are reporting more buyers than sellers. Even at $75, the public continues to acquire silver, chasing the upward momentum. This suggests that secondary supply, such as the scrap market, is not acting as a price restraint. Individuals are retaining their silver holdings, anticipating further price increases. Their expectations of reaching $100 may well be accurate. If the public refrains from selling and mine production remains constrained, while banks are compelled to purchase, where will the additional metal originate? It will necessitate a price increase sufficient to overcome the psychological resistance of hoarders. $75 has not achieved this. Perhaps $100 will. Let us also consider the opportunity within the mining sector. Mining stocks experienced a challenging day yesterday, declining in tandem with the metal. However, today they are showing significant strength. Investors are recognizing that a silver price of $75 represents a highly profitable scenario for producers. Companies such as Hecla and Kerr Mines are generating free cash flow yields of 20 to 30% at these price levels. However, a crucial observation is that mining stocks remain undervalued relative to the metal itself. Historically, when silver reaches new all-time highs, mining companies should similarly achieve record valuations. This is not currently the case. They are lagging behind. This presents a significant catch-up trade opportunity for January. As generalist investors seek avenues to capitalize on the silver boom, they will likely turn to mining stocks given the difficulty in acquiring physical silver. This influx of capital could have a substantial impact on the relatively small mining sector, potentially leading to doubling in the share prices of small-cap silver miners within the first month of the year. Furthermore, we must account for the geopolitical calendar for 2026. The debt ceiling negotiations are slated to commence in February, followed by the BRICS currency summit later in the year, and the US elections are on the horizon. This macro environment is conducive to heightened uncertainty, a key driver for precious metals. The banks are aware of this, which explains their desperate efforts to cover their short positions today. They understand that maintaining a short position into 2026 would be financially perilous. They have de-risked their portfolios, implicitly acknowledging that the bearish outlook is no longer tenable. They are no longer willing to bet against silver. If the banks are disengaging from short positions, who will maintain a bearish stance? It is highly unlikely that anyone will, which is precisely why the price is ascending and short interest is diminishing. Let us examine market depth. On December 31st, market depth is typically shallow. However, on January 2nd, liquidity is expected to return. While increased liquidity usually dampens volatility in a supply-constrained market, it can reveal underlying realities. As the full market volume re-enters, we will gain insight into the true depth of the order book. I suspect we will find that the sell side is notably thin, with significant blocks of silver not readily available for sale until prices reach $80 or $85. The market may need to gap upwards to find sufficient liquidity. Therefore, it would not be surprising to witness another gap up on Friday morning. The momentum is too powerful to be contained. The psychological barrier of $70 has been surmounted, and the market's focus now shifts to $80, the next significant round number and a magnetic price level. Given that the Shanghai price is already approaching $80, arbitrage mechanisms are likely to facilitate a rapid ascent to this mark. We are observing a convergence of the paper and physical prices, a phenomenon that has been distinct for years but is now merging in an upward trajectory. The paper market is being compelled to acknowledge the realities of the physical market. In the subsequent segment, we will identify specific price targets for the coming week, employing Fibonacci extensions to forecast the path to $85. We will also discuss potential danger zones where volatility might re-emerge and provide a final checklist to ensure preparedness for the opening of 2026. The year has concluded, the immediate battle has been won, but the broader conflict for fair valuation has only just begun. We are witnessing a blue sky breakout, where an asset closing at its yearly high signals to technical analysts worldwide that selling pressure has dissipated and there is no significant overhead supply. No investors are waiting to exit at $76 because virtually everyone is in profit and inclined to hold, anticipating further gains. Therefore, let us examine the specific technical targets for the first week of 2026. Using Fibonacci extensions, we project potential price pauses, measuring the move from the breakout level of $50 to the consolidation at $65. The initial significant target is the 1.272 extension, which aligns precisely with $85. This is not an arbitrary figure. $85 represents a level where algorithms are likely to pause their aggressive buying. Consequently, if you're observing this broadcast on Friday, January 2nd, anticipate a potential gap up and a swift run towards $80. The magnetic pull is substantial, but there exists a secondary target, the psychological milestone of $100. In a runaway or parabolic market, technical resistance levels can be easily overcome. The market may bypass $85 and head directly towards triple digits, particularly when fear of missing out, FOMO, outweighs profit-taking instincts. We are observing indicators of extreme FOMO building within the retail sector, evidenced by surging Google searches for how to buy silver and a vertical increase in YouTube views on silver-related content. The general public is becoming increasingly aware of silver's potential. Unlike institutional investors, the public often holds onto their silver, burying it rather than selling it to hedge their positions, thereby permanently removing it from circulation. Now let us address the potential danger zones. It would be irresponsible to suggest that the price will only increase. The bank sustained significant losses today, becoming wounded entities, and wounded entities can be unpredictable. During the initial weeks of January, they might attempt to re-establish short positions, leveraging higher prices to initiate new bearish trades and potentially create a double top formation. If successful, this could lead to a sharp correction back to $70, retesting the breakout level. Such a scenario would be unsettling and would flush out any remaining leveraged positions. However, this reshorting strategy is ultimately doomed to fail due to the physical supply vacuum. It is impossible to effectively short a market that lacks adequate inventory. If the banks attempt to drive down the price by selling paper silver, arbitrage bots will purchase this paper and demand physical delivery, depleting the remaining ounces from vaults. Any effort to crash the price will, therefore, only accelerate a default scenario. The banks are caught in a prisoner's dilemma. If they attack, they lose the physical metal. If they do nothing, they incur financial losses. Let us examine the industrial inventory cycle. We briefly touched upon this, but it is crucial for the first quarter. In January, industrial companies will report their earnings and inventory levels. We anticipate hearing CEOs express concerns about material shortages, with companies like Samsung and Tesla likely reporting difficulties in sourcing silver. When such headlines appear on financial terminals, it will validate the investment thesis globally, shifting the narrative from speculation to a genuine supply chain crisis. Capital flows are expected to rotate from technology stocks into commodity-related equities, a rotation that is characteristic of a supercycle. We must also monitor the interest rate narrative. The Federal Reserve claims to have inflation under control, but silver trading at $75 suggests otherwise. Silver is acting as a truth teller, indicating that inflation is structural rather than transitory. As silver prices rise, they will compel the bond market to price in higher long-term inflation expectations, which will negatively impact the bond market. As bonds decline in value, capital will flow into silver, creating a self-reinforcing loop. The higher silver prices climb, the more it underscores the systemic issues within the financial system, further driving its price upward. Therefore, what should be your strategy for the initial week of the year? Observation is key. Do not rush to sell. The first week of January often sets the trend for the entire year. If we conclude this week with a green candle, statistical data suggests a significant upward trend. We need to see follow-through buying on January 2nd, 3rd, and 4th. If this occurs, it will serve as a definitive buy signal. Your allocation to silver will now represent a larger percentage of your net worth than it did a month ago. While this is positive, it also signifies an increase in your risk exposure. If you're experiencing sleepless nights or excessively checking prices, you may be emotionally over-allocated. However, avoid selling solely to alleviate anxiety. Anxiety is an inherent part of participating in such markets. Instead, focus on the fundamental value proposition. The market is attempting to reprice silver to a level that balances supply and demand. We have not yet reached that equilibrium. We're transitioning from exceptionally low pricing to merely very low pricing. It's unwise to divest an asset currently priced very cheaply simply because its prior valuation was absurdly low. Await its appreciation to fair market value or a significantly higher, even extravagant price point, potentially hundreds of dollars more. In the concluding segment of this presentation, we will summarize with the ultimate objective. We will examine the specific indicators to monitor on Friday morning. We will address the dealer markups. Are they diminishing or escalating? Furthermore, we will deliver our definitive judgment on the year of the constrained supply. The governmental tightening measures were merely the initial phase. The true scarcity crisis materializes when the general populace comprehends the complete depletion of available silver. Financial institutions were compelled to procure assets. Investment funds were obligated to present a favorable appearance, and the marketplace was compelled to acknowledge a novel paradigm. However, we must now observe the quietude preceding the upheaval. Tomorrow marks New Year's Day. The financial markets will be shuttered. It is a period for contemplation, a moment of tranquility. Yet on Friday, January 2nd, the floodgates will burst open. The year 2026 commences, and its inauguration features a confluence of circumstances statistically ideal for an exponential price surge. Within this final, detailed analysis part 4, I shall equip you with the strategic plan for Friday morning. I will elucidate why dealer premiums represent the sole critical indicator at this juncture. I will demonstrate how the year of the constrained supply is not a mere catchphrase, but an unavoidable mathematical outcome. And I shall provide you with the essential psychological fortitude required to maintain your holdings when global sentiment becomes irrational. The current year has concluded. However, the annals of history are just beginning to be written. Let us bring this to a conclusion. Friday morning, January 2nd. This is the day the pension funds, which we have previously discussed, will definitively initiate action. They have finalized their new investment allocations. They have approved their revised budgets and are now observing a price chart that has just closed at unprecedented highs. What transpires at 8 o'clock Eastern Time on Friday? We are likely to witness a significant upward price gap. The upward momentum from today's closing will persist. Algorithmic trading systems designed to capitalize on strength will become active. Short sellers who deferred their covering today will find themselves in a precarious position. It is plausible that silver could open at $77 or even $78. Should this occur, refrain from aggressively pursuing it with borrowed funds. Price gaps are inherently volatile and can be filled. However, it is crucial to grasp what this gap signifies. It indicates a profound deficiency of sellers. No one is inclined to divest on the initial trading day of the year. The overwhelming sentiment is to acquire. This imbalance compels the price to surge dramatically. If we observe an upward gap on Friday, it validates that 2026 will be a period of runaway market appreciation. It signifies an acceleration of the price discovery phase. We are transitioning from a stable base to a rapid ascent. I have reviewed the major online platforms. The price of a silver eagle coin remains elevated, hovering close to $90. The price differential is $15. This is the definitive indicator. If dealers believe that $75 represented a ceiling, they would be reducing their premiums to liquidate inventory. They would be actively seeking to offload coins prior to a market downturn. However, this is not the case. They are maintaining elevated premiums because they recognize that $75 is, in fact, the floor. They are aware that replenishing this inventory in January will cost them $80 or more. Consequently, they are factoring future price increases into their current pricing. The physical market is effectively trading in the context of 2026, while the derivatives market remains anchored in 2025. This divergence serves as your protective buffer. As long as the retail price consistently exceeds the spot price, the bull market is robust. It indicates genuine demand from individuals acquiring physical metal Rather than merely automated trading of paper contracts, let us broaden our perspective to the annual time frame. The reason I designate 2026 as the year of the constrained supply is that the available buffers have evaporated. In 2024, we had reserves in London. In 2025, we had inventory in various repositories. In 2026, we have effectively nothing. The registered inventory is practically non-existent. The eligible inventory is held by strong, long-term owners. Mining output is stagnant. Demand is increasing exponentially. This year, the market will be compelled to establish a price point that eradicates demand. It will need to identify a price that forces manufacturers to cease battery production. It will necessitate a price that compels you to liquidate your holdings. We understand that this price is not $75. It is highly improbable that it is even $100. Therefore, the market has a substantial task ahead. It has a considerable distance to traverse. This implies that 2026 will be characterized by exceptionally volatile price surges. We will witness days where silver appreciates by $5. We will experience weeks where its value increases by $20. This is the consequence of releasing a compressed spring in a vacuum. There is no resistance, only velocity. I wish to impart a final reflection on the act of holding. Acquiring an asset is relatively simple. Retaining it proves challenging. When silver reaches $80, you will feel like a visionary. Upon its ascent to $90, you will perceive yourself as invincible. And if it subsequently retreats to $80, you will feel like an imbecile. It is imperative to decouple your self-esteem from market fluctuations. You are not a genius when prices rise, nor a fool when they decline. You are a steward. You are safeguarding a strategic resource that the global economy requires. Your sole responsibility is to maintain its security until the market offers you a commensurate valuation. Fair value is not quantified in monetary terms. It is measured by your purchasing power. Can your current holdings facilitate the acquisition of a house? Not yet. Can they enable the purchase of a farm? Not yet. In that case, the investment is far from complete. Do not liquidate for mere comfortable living expenses. Aim for generational wealth. That is the ultimate objective. Therefore, here is the verdict on the regulatory tightening observed on December 31st. It served as the essential catalyst. It compelled financial institutions to reveal their precarious positions. They are vulnerable. They are ensnared. They acquired assets at inflated prices. We are entering the new year with considerable tailwinds. The upward trend is undeniable. The fundamental economic indicators are overwhelmingly positive. The technical market signals are perfectly aligned. Please enjoy your New Year's Day. Celebrate with your loved ones. However, be prepared for Friday, because when the trading bell rings on January 2nd, the January effect will commence and the world will discover the true extent of silver's scarcity. You were early, you were correct, you are prepared. Welcome to the year of silver. Please subscribe.